Welcome everyone to our halftime report by Advanced Portfolio Strategies, our firm. We're happy that you're all here and we're looking forward to sharing some important information with you. Next, I want to draw some important attention to you, which is our disclosures. Please take a few moments to review, and if you have any questions, feel free to ask at the end of this presentation. One of our goals today is to review the first half of 2022. As usual, it's impossible to cover everything that's happened this year, so we're going to take a closer look at some key developments that drove U.S. equity market performance in the first half. We're also going to examine the forces that may influence the markets in the second half of the year. This presentation, I'm going to try to keep it as high level and as simple to understand, but given the nature of the economic conditions and things like that, I'm going to try to go into a little bit more detail to try to help you understand our perspective of what's going on. So I apologize if it does get too technical. Feel free at the end just to answer any questions that you might have. If you were unsure of certain data that I was sharing with you, feel free to ask a question. There are no dumb questions. These are complex ideas that we're going to be discussing, so we try to make them as simple as possible. But if you have questions, please, by all means. Let's begin by reviewing how the stock market performed during the first half of 2022. Here's a snapshot of the S&P 500 index performance from December 31st, 2021 to June 30th, 2022. The S&P 500 Composite Index, as shown here, is an unmanaged index that is generally considered representative of the U.S. stock market. Now, just as a reminder, index performance is not indicative of the past performance of a particular investment, and past performance doesn't actually guarantee any future results. And as an individual, you cannot directly invest in this. The S&P 500 fell steadily throughout the course of the 6 months of the year as economic growth cooled, inflation picked up, and the Fed began a pivot to tighter monetary policy. And I'll note here that the first half of this year, the performance of the S&P 500 as an index, and certainly in markets in general, was the worst first 6 months since 1970. So, since over the last 50 years. So that was, you had to go back to 1970 to have a worse performance than you saw this year. So it's been a pretty strong downdraft, and we'll try to explain some of the forces behind that. As you can see from the milestones marked on the chart, investor enthusiasm was dampened in January as the consumer price index came in at 7%. Fed Chair Jerome Powell surprised markets later that month with talk of shrinking the Fed's balance sheet. And in late February, the market learned about the invasion of Russian troops into Ukraine. On March 16th, the Fed implemented its first rate hike. A short time later, we learned that inflation was hitting a 40-year high. The negative sentiment gathered momentum in April and May, and when the Fed raised rates again, this time by 50 basis points. Markets continued their struggles in June as recession fears grew, and May's CPI release showed inflation had reached a 40-year high again. In response to this elevated inflation and rising inflation expectation, the Fed hiked rates by 75 basis points in mid-June, 75 basis points being 0.75%. So we've talked a bit about how the S&P 500 performed so far this year, but how does that performance compare to expectations? At the end of each year, various media outlets compile some Wall Street analyst predictions for the year ahead. This image shows several projections shared at the end of 2021. How do those predictions compare to reality so far? From the previous slide, we can see that the S&P 500 closed on June 30th at 3,785. The S&P 500 closed at 4,766 on December 31st, 2021. The forecasts for 2022 were very modest, as this table suggests. Even the most optimistic forecast in this table represents a less than 10% increase for the year. The outlook was reflective of expectations that economic growth would moderate, while interest rates would likely be higher. Predicting where the S&P 500 will be by the end of the year is always challenging, to say the least, especially in 2022, given the uncertainties of inflation, global economic growth, and rising interest rates. Now let's take a look at some economic and financial indicators to help understand how we got here. Let's start at January 2022. 17 of the 20 leading indicators shown above reported strengthening or positive numbers and no negative indicators in January. Perhaps the most notable of the three neutral indicators is the equity market valuation dial that you can see down on the lower right. Nevertheless, the year began with an optimistic outlook for the economy and capital markets, especially because we were pulling out of the pandemic. By June 2022, however, there was a more decidedly mixed outlook. While there is only one red indicator, that geopolitical risk, mainly due to the war, there are fewer green indicators than just 6 months ago. In fact, 8 inputs moved from green in January to yellow in June, including monetary policy, yield curve, housing mortgages, interest rates, fiscal policy, international economic outlook, inflation, and energy costs. The indicators reflect a shift in the Fed's monetary policy, the continuing overhang from the pandemic, such as supply chain disruptions that have elevated inflationary pressures. Also, the war in Ukraine has unsettled overseas economies and driven energy prices higher, while China's zero COVID-19 policy has hurt its economic growth and exacerbated global supply chain issues. This chart shows the relationship between changes in S&P 500 performance and the 12-month forward earnings per share, or EPS. As you can see, the two lines have generally moved in the same direction over the past decade. During 2020, the volatility in stock prices and earnings was the result of COVID-19. As markets rebounded on the expectation of economic recovery, earnings rose, but not at the same rate as stock prices, creating a wider gap between prices and earnings, meaning that you had a valuation multiple, what we call a multiple expansion. In other words, the price paid per earnings, that figure was going up. As you can see, this gap closed in 2022 as stock prices have come down and corporate earnings have grown. So you can see that there on the upper right hand of that chart, where you saw a steep decline in pricing, which is the orange line, and then the 12-month forward earnings continued to grow. And we're going to talk a little bit about that earnings number in a little bit later in the presentation. At the highest level, the Federal Reserve has three functions: to provide an effective payment system for the U.S., to regulate banking operations, and to set monetary policy. When determining monetary policy, the Fed is tasked with supporting maximum employment, stable prices, and moderate long-term interest rates. As it works to uphold its monetary policy goal, one of the indicators monitored by the Fed is the overall level of consumer prices, which helps it determine whether to adjust interest rates. The Fed has stated that it's comfortable with inflation in the 2% range. This line graph shows the Consumer Price Index, or CPI, and core CPI, which excludes food and energy prices, over the last 50 years. The chart is through May. On July 13th, the June CPI was released, and it showed an increase in 9.1% core CPI, which excludes food and energy. Rose, and food and energy with 5.9%. Inflation became a principal worry for investors in 2022, since rising prices may hurt corporate profits, reduce the business investment necessary for future growth, and influence the spending capacity of consumers. As inflation has become more persistent than originally anticipated by the Fed, there's a growing anxiety that inflation could play a role in moving the economy towards a recession. The pace of inflation will also dictate Fed policy. Notice the PCE, or personal consumption expenditure, numbers at the bottom of the page. This is the measure of inflation that the Fed watches most closely for making decisions on interest rates. Right now, it is above the Fed's 2% target. And though the Fed has said it's comfortable with overshooting its target for a brief period, this elevated PCE may keep pressure on the Fed to raise rates in the months ahead. Everyone in this audience, no doubt, may have felt the impact of inflation. For some, it can be especially difficult to adjust to rising prices. This chart is instructive for a couple of reasons. First, it shows the various contributors to each month's year-over-year inflation rate. As the bar chart suggests, inflation has hit consumer wallets on nearly every level, from food and energy to eating out and new and used cars. The overhang for markets in 2022 has become whether inflation continues to rise or plateaus and comes down from here. Economists have pointed to a number of reasons for the emergence of inflation, including monetary policy, strong consumer demand during a period of supply chain problems, and fiscal stimulus that help create greater consumer demand. Let's take a moment to talk about wages and unemployment. This graph shows the unemployment rate and year-over-year wage growth for the past 50 years. Do you notice anything about how these two lines relate to one another? Most of the time, wages and unemployment have an inverse relationship. When one goes up, the other goes down. This historical correlation has been a bit murky in the post-pandemic period, which has witnessed a recovery in the labor market as the unemployment rate continued to decline in the first half of 2022, while wage growth has been strong. The good news is that workers appear to have more opportunities to find employment and get paid a better wage. The bad news is that the inflation rate has outpaced some wage gains. The University of Michigan Consumer Sentiment Index is one of the most widely used sources to help analysts understand how the average consumer feels about the economy. This index is valuable as it surveys at least 500 residents of the U.S. each month by phone. The survey uncovers consumers' opinions regarding their own finances, as well as business conditions in the country. Understanding how people feel about the economy is essential because consumer spending accounts for more than 2/3 of gross domestic product. As the chart indicates, consumer confidence has been trending lower in 2022. That's understandable given the acceleration of inflation, the invasion of Ukraine, rising interest rates, and the ongoing supply chain issues. Economists will be watching how lower confidence influences consumer spending for the remainder of the year. Further, as the world's second largest economy, China has a significant impact on the global economic activity in two distinct ways. One, as a consumer of products and services, and two, as a manufacturer of goods and services that are in demand worldwide. China experienced a COVID-19 outbreak in the first half of 2022. Its zero COVID-19 policy led to complete and partial economic lockdowns throughout the country, but especially in important economic regions and cities such as Shanghai. In the first chart, you can see the rapid acceleration of COVID cases in Shanghai between April and May 2022. These lockdowns shut factories and ports that make and ship essential goods in the global supply chain. As you can see in the second chart, the lockdowns have slowed manufacturing and other business activity in China, leading to a slowdown in their economy that investors fear may influence Western economies. Also, China's actions hurt an already fragile global supply chain, impacting American businesses and consumers in the form of product shortages, delivery delays, and higher prices. The most devastating consequence of Russia's invasion of Ukraine is the human toll in lost lives, destroyed communities, and a decimated economy. As you may have heard, many countries, including most of the world's largest economies, responded to the invasion with economic sanctions against Russia. Russia has been a major exporter of energy, metals, and wheat. These sanctions have led to sharp increases in the price of oil, natural gas, some metals, and certain food items. The invasion has limited the ability of Ukraine, a major wheat exporter, to produce and export this commodity. Global supply chains, in turn, have been stressed as European countries have been forced to find new suppliers for their energy needs, and manufacturers have struggled to replace their sources of base metals. The net effect has been a general lowering of global economic growth projections. Finally, there are longer-term implications around what the impact will be on the world economic order of the post-World War II period. For instance, we already see a move to reshore critically important manufacturing, like semiconductors, as policymakers and business leaders ponder a future scenario in which China might invade Taiwan, a key producer of semiconductors. Before we move on to our outlook for the second half of 2022, let's take a moment to consider the variables that could upend such forecasts. We believe that the factors that led to the first half market downturn may remain critical to how the market may behave in the second half. The first factor is inflation. The big question mark is whether inflation has peaked or will continue to accelerate. In many cases, the Fed may likely remain quite hawkish as it seems to move monetary policy ahead of the inflation curve. The Fed raised rates by 75 basis points at the Federal Open Market Committee meeting yesterday, which was largely expected. And they also mentioned that potential future rates might be in order, though Powell did mention that they may see a slowing of rate increases as we move on into the next year. The question is whether inflation conditions require them to be more aggressive with rate hikes later in this year. So I think that's the big question that everybody's pondering. We're going to talk a little bit more about that. Another risk is bond yields. As the Fed raises short-term interest rates, bond yields long in the curve are likely to trend higher. Interest rates may have substantial impact on economic growth as it becomes more expensive to borrow money. The other implications for stocks is that higher bond yields may suddenly make bonds more attractive, providing investors with an alternative to stocks that may not have existed for them when rates were near zero. We've actually seen this in the markets recently. We saw a big move up yesterday, and we saw a big move down in yields, which means people were buying bonds and taking advantage of those higher yields. And I think it was basically on the back of people expecting the Fed to be a little bit more dovish, or at least not as aggressive as they thought. So that's one thing that we're monitoring. Corporate profits also loom as a potential risk to stocks. In the first half of 2022, the market punished many stocks and companies fell short of sales and earnings estimates. During anxious markets, investors may be more focused on the corporate earnings as evidence that current valuations are fair. Consequently, corporate America might need to deliver on profits if market sentiment is to improve at all. Now let's dive into some forecasts for the second half of the year. Discuss some of these market forces. The sharp post-pandemic economic recovery is firmly in the rearview mirror. As you can see in the chart, the Federal Reserve projects that the economy will veer toward more historical norms of economic expansion in 2022, 2023, and 2024. So in fact, just today, it's not in my presentation, the numbers, but we had yet another negative print on real GDP growth of negative 0.9. So that makes 2 quarters of real GDP growth negative. Just to comment on that, you hear a lot about 2 negative quarters, that's a recession. Well, the National Economic Bureau of Research does not necessarily look at just 2 negative real GDP. They also look at other factors. So they're the ones that typically come out and say, hey, yeah, we're in a recession. I think the bigger point here, though, is that the economy is definitely slowing. And that's we're starting to see that in demand and various demand for services and goods, and also in hiring. Of course, positive or negative surprises on GDP growth in the second half may influence financial markets. In part, corporate earnings are reliant on the pace of the overall growth in our economy. Remember, forecasts are based on assumptions and subject to revisions over time. Financial, economic, political, and regulatory issues may cause the actual results to differ from the expectations expressed in the forecast. Some market strategists look at the bottom-up earnings per share to help set their price target for the S&P 500 index. When setting a bottom-up EPS, market strategists focus their attention on estimated earnings for all of the S&P 500 companies. By contrast, a top-down investing target price places a greater emphasis on macroeconomic factors when making an investment forecast. This chart shows the bottom-up EPS and the price of the S&P 500. A word of caution on this type of analysis: it shouldn't be seen as a flawless predictor of future stock price performance. That said, note how stock prices go ahead of corporate earnings, leading to more expensive valuations. As the market corrected over the first 6 months of 2022, you can see price levels now have dipped below the projected earnings line. Inflation fears have also weighed on the stock market. This slide shows what market participants expect inflation to be over the next 10 years. As you can see, these expectations rose throughout 2021, but have moderated a bit in 2022. The intersection of economic growth and inflation will likely be critical to investors, since one emerging concern is the idea of stagflation. Stagflation is an economic environment characterized by slow growth, rising unemployment, and elevated inflation. Now, I will say we don't really have the conditions for stagflation right now. We do have slowing growth, and we do have elevated inflation, but we don't have rising unemployment. We're still showing great job numbers, and we're still showing a very, very low 3.6% unemployment rate. That's why a lot of economists out there are still saying, probably not in a recession, because normally recessions see sharp rises in unemployment. And so that's the one big argument against the idea that we're going to be going into a recession. The Fed is pursuing a more aggressive monetary policy to combat today's high inflation, which is why the remaining FOMC meetings are so important to the markets. The forecast for the 10-year break-even inflation rate is based on assumptions and subject to revisions over time. Financial, economic, political, and other regulatory issues obviously may cause the results to differ from expectations. So let's examine what are the causes of this current inflationary pressure. I think it's important for us to really understand. It's pretty clear to most economists. The source of inflation was the pandemic. Prior to 2019, we had very subdued inflation. We had fairly stable markets. We didn't have the volatility that we have today. But it's changed by the pandemic, and in particular, the policy responses. Lockdowns, travel restrictions, testing, isolation, mandates worldwide caused unprecedented disruption to supply chains and labor force participation. And those were key, those two things: supply chain disruptions and labor force participation. Those two things are tightly wound together in this scenario. So, and to counteract the economic impact of those policy decisions, governments provided unprecedented monetary stimulus. I think globally it may have been somewhere around 8 or 9 billion of new money that was injected into the global economy. If we look on a dollar basis, the 7 billion of that coming from the United States. So a tremendous amount of money injected into the system, right? Just creating money to offset these impacts. But this was a one-two punch, right? So what happened was the monetary stimulus spiked demand. It caused demand to go up because people were flush with cash, balance sheets. They paid down their debts, balance sheets were strong. But at exactly the same time, supply fell. So supply of lots of goods, and a lot of you have already heard a lot about this, but that 1-2 punch, that's the perfect recipe for inflation. It's a simple supply-demand relationship. And so when we look at it, that's the cause of inflation. So it's our view that, looking back, it'll be questionable whether these kind of policies in a pandemic scenario can be pursued, or at least can be pursued as long as they were for this pandemic, because it's caused an incredible amount of economic damage. Rapidly rising inflation obviously forced the Fed's hand. Consequently, the Fed funds rate was raised another 75 basis points, or 0.75% yesterday, to 2.5%. In addition to raising rates, the Fed is also allowing its balance sheet to shrink by stopping bond purchases and requiring banks to raise their reserves, which has the kind of net effect of slowing down lending. The effect of this is to stop the growth of money supply, which translates into tighter financial conditions, right? So that affects, just on a money supply basis, that affects um, namely borrowing and financing costs for business development and actual personal consumption. The question is, this is the big question: can the Fed raise its target funds rate without causing a recession? Right. So I've used this word a few times. What's a technical recession? Supposed to be 2 negative quarters. Well, we've seen that, though it's actually more nuanced than that. And we may or may not be in a recession, but we can for sure say we're pretty close, right? So this chart above shows that while the track record is not good, there have been a few times when a soft landing was actually achieved. The critical offset is the health of the labor market. I mentioned that earlier. With unemployment at all-time lows, there may be yet enough consumption power in the tank of the consumer to help power us through a higher rate environment. So there's a lot of research that we read out there from the economic research from our collaborators and other firms that we read. A lot of them are making the argument, look, hey, this is yeah, we're slowing down, but we got a really healthy consumer, and we have a really healthy labor market, so we don't really see consumption might slow down, but we don't really see like a contraction in spending and a rising unemployment. So that would be the Goldilocks scenario where we have that soft landing. You can see there that 3 of the last 13 primary Fed tightening cycles, you can see 3 of those have had soft landings. So we'll see. We don't know. It seems like it's in our favor to have a soft landing because of the labor market, but time is going to tell. So inflation has a very negative effect on economic growth, right? Rising prices, especially in core goods, causes consumers to make decisions between discretionary and non-discretionary purchases, like food and gas would be considered non-discretionary. You need to have those. This has the knock-on effect of reducing demand. As demand for goods and services falls, so do prospective sales and earnings of companies. And we're already seeing some of the early warning signs of this in sales and earnings outlook this past earnings season. With cuts in earnings forecasts, we have seen investors heavily discounting share prices, and so that's the connection here. What we've seen in this first half of the year is that investors are looking at these companies and thinking, well, okay, for sure we're going to have sales and earnings revisions, and if that's going to happen, we need to discount the prices, because all things being equal, we're not going to pay the same amount for reduced earnings. So we have to lower the price, right? So that's when you start to go into kind of a bear market. We'll get into that a little bit later. But so the question is, does the sell-off overshoot? Like where is that value? So you can see that inflation has had a very negative. You can see here that in the market, in the rising interest rates, how it's hit stock and bonds from year to date. This is actually from a print last Friday. It's through last Friday, so it's not including the market action this week. But you can see the reason why I show you this chart is because you can see we had a good week last week. Everything was up, stocks and bonds. But you can see year to date, the negative performances, but more importantly, I want to point out is that negative performance in bonds. Even holding, what we consider the risk-free 10-year Treasury note is down 10%. So this has hit all parts of the portfolios that we manage, except for those parts that are in energy and commodities. So which energy and commodities have done fairly well, but everything else has taken a hit because of the rising interest rate and the inflationary environment. So with the prospect of lower earnings and higher financing costs, investors subsequently discounted stock valuations. Price to earnings ratios fell from 21 times at the beginning of the year to 15.8 times earnings, right? That's a big re-rating of the valuations. This level of heavy discounting suggests that investors are indeed expecting a recession, although the economic data has not quite confirmed that for reasons I explained before. You can find ample arguments both for the recession scenario and the soft landing scenario, but the challenge we have is that we generally know only after the fact, which does not help making investment decisions if you're knowing that we're in a recession or it's a soft landing after the fact. More importantly, by the time a recession is announced, we're typically 3 to 6 months past the trough of market pricing. So if we're basing our investment decisions on someone coming out and saying, "Hey, yeah, it's official, we're in a recession," we might likely have already reached the market bottom because the stock market's looking out well ahead, typically 6 to 12 to 18 months. So that's a danger if we're trying to market time our portfolios based upon economic data that's backward looking, and we're basing our decisions upon that. This chart shows the trajectory of market returns after a bear market has been reached, which is defined as a 20% drop in prices. The left side of this chart shows the decline from the breach of that 20% into bear market territory, like I said, through the final trough. So it's 20% down to the final trough. The purple bar shows the entire data set of all those events, while the gray bar shows when there was an economic recession, and the turquoise bar shows when there was no economic recession. The right side shows the recovery for each of those data sets, both 6 and 12 months following the initial decline of 20%. You can see that in all cases, at 12 months following the 20% decline in markets, the markets were making significant recoveries, with the average of all being at 11.8%. I showed this data point because, people start to freak out when they see these large declines. And we head into a bear market, like I said, arbitrary, but a bear market's down 20%. We hit that in the S&P. We're not there anymore. We bounced in the S&P, but we hit that in the S&P. We certainly hit it in the NASDAQ. And so, we breached that. We went into bear market territory, and here we are. We're already bouncing back. And yesterday we had, significant 3 and 4% performances with the S&P and NASDAQ respectively. And that's a really critical point because, as we've said to many of you by phone and in our meetings, most of the return in any given year is typically explained by 10 trading days. Just 10 trading days. And that's so if you, in other words, you summed up all the market performance in all throughout the year, the ups and the downs each day, 10 days would account for the majority of the gain in the year. So it's really difficult to be out of the market in those days. And yesterday may very well have been one of those days. I mean, a 4% move in the NASDAQ, that's significant. So, and again, there's probably a lot of reasons why that was happening, and we can talk about that, but that's what happens. And before you know it, the bottom's already formed. And if you're out of the market, or you sold and went to cash and you're out of the market, you just missed probably 1, 2, maybe 3 of those 10 trading days over the course of the next 3 to 6 months by the time you get comfortable going back in. That's a big argument for not going to cash and trying to market time. So we've talked about that many times, but that's one of the core reasons. So that leads me to my final point, which is staying focused on the fundamentals. We have to tune out the headline noise, especially from the financial press. Most of that stuff is clickbait, meaning they just want you to click on so they can sell advertising. It's not really good. The journalism is just not good anymore. So you have to be careful of what you're reading. As I like to say to people, curate your data feed and your in your your news items in your Facebook or in your Apple News or whatever it is. Curate it. Make sure that you're not just getting junk sent at you for that's clickbait. You know, wise investing involves more than just reacting to those headlines that may discuss consumer sentiment or geopolitical developments. For investing opportunities, generally the golden rule is stay focused on the fundamentals, like a company's earnings or economic data. And we've been sharing some of that with you today. And again, it's hard. The crystal ball doesn't always work. We have one here in the office, and most of the time it's not working that well. So in lieu of that, we have to really take a look at the data and try to assess the overall risk that we can. And we've certainly in our portfolios over the last 12 months, we definitely have made some more defensive positions into value stocks and dividend earning stocks and dividend growers. But generally speaking, we're not wholesale getting out of equities because we see this kind of market action. We've gone over a lot today, and if you remember just one detail from our presentation, we hope it's this. Emotions, they don't have any place in investing. Market corrections are a normal part of market cycles, and the first half of 2022 is a good reminder. I always like to say to people, market corrections are a great disciplining force. It flushes out all the bad investments, all the dumb money chasing things that are not earning what we call economic rents and have no prospects for earning economic rents. And in bull and bear cycles, we always have that. We have these retrenchments in market pricing precisely to blow out these bad investments. And that's what these recessions or market corrections serve. So always remember that these are healthy things. Recessions and market corrections are healthy. They're not unhealthy, even though we obviously always want growth. Now, this chart shows the intra-year lows each year going back to 1980 in yellow, with annual returns shown in gray. As the chart illustrates, there have been many years that saw declines intra-year, sometimes steep declines. Volatility can be uncomfortable, but it is normal. Managing your emotions during good times is just as important. Ultimately, taking a long-term view of the markets is essential when pursuing your long-term goals. If you ever feel concerned or want to understand what's happening, lean on us for support. We're here to help you. And we want to help you make the most of your financial life and make good decisions, both through our portfolios and our investment management, and also through our financial planning. This slide shows why it's important to tune out the noise and focus on your time on horizon, risk tolerance, and goals. If we look at the market since 2006, we can see the danger of missing some of the market's best days, which I was talking about before. As this chart illustrates, a $10,000 investment on January 2026 would have increased to more than $45,000 by the end of 2021. But had an investor been out just those 10 best days during this period, that investment would be worth only $20,000. If an investor missed 20 of the best days, that investment would be worth only $12,000, a little more. Miss 30 or more of the best days, and you're losing money. Investors who sell stocks in response to difficult market conditions often miss those all-important best days. Okay, so we've come to the end of our presentation. Many of you have still lingering questions. Any questions that you might have? I'll give it the old college try here. Do we have any questions?
Hey, Daniel, this is Kenneth. Can you hear me?
Yes.
So the question I had was, I just saw the news about the House passing the $280 billion chip stimulus of Congress. I know it still needs to be reconciled, but was wondering what impact on inflation would be from that.
But impact on inflation?
Yes.
So that the chips bill, if signed into law, is going to give subsidies to chip manufacturers to develop chip plants here. It's that's it. So it won't have any direct impact because that's going into, it's almost like government investment in direct investment into manufacturing, and it should produce jobs. Now, to the extent that the jobs are producing, higher wage or driving higher wages up, and that could be inflationary. But I think the net effect of that should not be inflationary, mainly because it's not going necessarily to it's not direct checks to consumers. It's actually investing in plant and equipment. So I think that it would, if there is any inflationary impact, it would be muted. But that's a good question. So if there's no other questions, we can sign off. And if you want, you can always reach out to us, give us a call, or and schedule an appointment with us if you have specific questions about your portfolio. It's been I'm sure you must have some questions about that because it's been a pretty dramatic year. But for the same reasons that I've argued today, despite what's been going on in the markets, it's very important to remain invested, earn the interest, earn the dividends, and particularly take advantage of lower pricing by maybe stepping up your investment levels or any extra cash that you have to take advantage of the pricing. It's not to say that we're going to go back to 21 times earnings, but over the long run, you're just buying good companies at lower prices. So that's the opportunity. And typically what we've been doing for our clients, any new monies and things like that coming in, is we're dollar cost averaging. We're trying to invest into that bottom of the market. We do believe that the market's forming a bottom right now, meaning it's sort of like bumping on the bottom. We could see it going up and down, and we could maybe potentially test a new low, but it wouldn't be that much more of a low if it did. It'd be very incremental. And I think that we're starting to see the economy slow and hiring is going to moderate. So we're pretty optimistic for the second half of the year. So if there's no other questions, then we'll sign off, and we look forward to speaking with you in January or February with our annual market report. Take care.